Returning back to the Zoom stock chart example demonstrates the difference between horizontal price ranges, channels, and the combination of trend lines with horizontal price levels. All these elements can produce strong breakouts, but a flat trading range will of course be less predictable due to the inherent neutral price action. And as we've seen, channels are sloped, showing clear directional bias from the beginning. So channels are inherently skewed upwards or downwards. As seen earlier, there is also a tendency for steepening of an incline after the upper boundary of a channel is crossed. Likewise, when the lower boundary of a channel is breached, bearish price action also tends to steepen. Then when a single trend line is combined with a horizontal level or range, the result is often various types of triangle formations. Like a normal trend line, Zoom is tipped upwards on this trajectory to form an ascending triangle with a characteristic strong break to new record highs above the firm 160 resistance area. This combines the sloped element of trend lines and channels, in this case with a bullish context, pushing against the neutral to bearish element of the horizontal resistance range. Now all this demonstrates the connection between basic elements such as price action and volume, leading to swing points, leading to resistance and support, along with trend lines and channels, to form a slightly more advanced and detailed method using chart patterns that shows the mixed elements of an upward trend line and channel pushing up against a firm range of horizontal resistance. But everything is essentially based on the simplicity of the core foundations that have been covered. Now let's take a look at an example of channels using a chart that doesn't have volume. This Forex chart of the British pound to US dollar, starting with two descending trend lines that are relatively parallel to contain price within a relatively broad band on the way down. And there's a clear demonstration of all the core characteristics for resistance and supporting price action discussed so far. This is especially true. Here it's a very steep bullish incline to break the trend line and this horizontal resistance range, but there's still the characteristic minor pause. So even though there's no volume during this near vertical climb, the analysis is quite accurate for the expected minor pause. It is a strong bullish move, but due to the confluence of trend line along with the horizontal range, this is very normal and to be expected. The same features can be seen during the rapid decline in March, which also demonstrates a case where the upper boundary of a channel has been breached, but the lower boundary has not, so it still offers some supporting influence, especially during the major upward reversal here. Overall, this has turned out to be somewhat of a bad channel. It's not very parallel at this point with the lines converging. But that just goes to show there isn't always perfection and mistakes can be made. And despite that, there is still some flexibility and useful analysis as long as the core ideas of technical analysis are followed, such as what was seen here. Useful guidelines were maintained by following simple principles of price action and swing points. Here's a moderate skewed downward channel that adds a validity to this established horizontal resistance range. Confluence of downswings forming at both the trend line of the upper boundary and the existing horizontal resistance range. And it also emphasizes the accelerated bearish break below the bottom boundary, this descending trend line broken along with these horizontal supporting ranges. A line chart with dots representing closing prices demonstrates the channel still would have been useful regardless of whether the downswing points penetrated above the upper boundary slightly more or slightly less, and it clarifies the lower trend line still remained valid because it wasn't broken prior to this major upswing. So this lower boundary of the channel, the lower trend line, remained highly influential and reliable, even though the upper trend line forming the upper boundary of the channel was already breached. In other words, it can be said the channel overall still remains influential, but this influence diminishes due to the prior breach of the upper portion, while the lower portion provides much of the reliability, as this trend line still remains highly valid. So when the market falls back here, it does have influence similar to the previous movement before the channel was breached. And on the way back out of the channel, there is still strong price action that is needed to overcome the residual resistance of this trend line and this horizontal resistance level.